Hi, welcome to our latest housing market update. Today we're diving into what's driving the housing market, the Fed's recent cut, and how all this is affecting mortgage rates. We've got some surprising insights, so let's get started. First of all, let's talk about the big news, the aggressive 50 basis point rate cut by the Federal Reserve, the first step in what could be a series of cuts as part of their new easing cycle. Thank goodness. But here is where it gets tricky. A lot of people think the Feds directly control mortgage rates, but they don't. Mortgage rates are driven by market forces like U.S. Treasury yields and mortgage-backed security. So what's really happening is that the bond market tends to predict where the Feds will go, meaning mortgage rates often move before the Fed makes it official, make an official announcement. Here is another head scratcher. The Fed's cut rates, but mortgage rates actually went up a little. How is that possible? Well, it's about the market expectations. The bond market had already priced in a 50-point cut before the Feds even made the announcement. By the time it became official, there wasn't much room for, any more room for rates to drop further. In fact, sometimes when good news is already expected, it can cause short-term rates moves in the opposite direction. But don't worry too much about day-to-day fluctuations. The rates have come down a little bit more and are around 6.09% right now, which is wonderful. The cut is just the start of a broader normalization process that could see rates drop by another 150 basis points by the end of 2025. So now let's go on to the housing market. August was not exactly a good month for home sales. Existing home sales dropped 2.5% from July and are down 4% year over year, and last year was a pretty slow year. In fact, the 3.86 million homes sold is the lowest level we've seen since October 2023, when mortgage rates were sky high, peaking above 8%. So why aren't lower mortgage rates boosting demand? There are a few reasons. Existing home sales, the contracts take 1 or 2 months to get into, and when mortgage rates were higher, and when rates drop, it takes time for buyers to find a home. Home prices are still high, making affordability still a little bit of a challenge, though it's gotten a lot better. Despite lower rates, home prices remain a significant hurdle. The median existing home price in the U.S. in August was $416,700, up 3% from last year. So appreciation is slowing, but still about 5% annually per Case-Shiller. Inventory has improved. It's up 23% from a year ago, but it's still far below what is needed to balance the market. So we have the unique situation where inventory is increasing, rates are dropping, yes, but prices remain high, and I think they'll stay there, keeping many buyers on the sideline. As Lawrence Young, the chief economist for the NAR, put it, the combination of lower rates and increasing inventory could set the stage for a stronger market soon. So while August might have been disappointing, the stage is set for a recovery. To sum it up, we're seeing a lot of moving parts. Retail sales are starting to stabilize. The Fed is cutting rates. The housing market is still struggling due to high prices and low inventory. However, lower mortgage rates and increasing inventory could be the combination we need for a stronger real estate market coming in the months ahead. So what is your take on the housing market? Are you planning to buy or sell next year? Let me know what you think, or are you going to wait it out? Don't forget, I'm always happy to answer any of your real estate questions. Thank you.